Hello, everyone. I'm so excited to interview Dalia Barzum, CEO of Streetwise Mortgages. Today's video, we're going to talk about everything about interest rates and the impact in the Canadian housing market. We're going to talk about questions about should you keep a variable interest rate or should you convert to a fixed interest rate? And well, the results might surprise you. We're also going to talk about what is the 3-year outlook on the Canadian housing market. And if you are a real estate investor, you might be wondering, like, should you hedge your portfolio? Because Bank of Canada did say they're going to raise interest rates over the upcoming years because we got to fight inflation. So how would you hedge your portfolio? We're going to talk about all that in today's video. So if you are an aspiring real estate investor or you are a real estate investor looking to buy more rental properties, then you definitely want to check out today's video. Hey, hi Dahlia. So it's really good to see you again. And we are going to talk about something that's on top of everyone's mind, which is interest rates and the impact on Canadian real estate. So I want to get your thoughts on this. I know. Okay. Inflation has really jumped up this year. I don't know if you've been tracking your grocery bill, but my grocery bill is like, whew, it's getting high. And we're facing supply chain issues. We're seeing, and obviously the invasion in Ukraine. And then it's impacting the commodity prices, the wheat. So, and Bank of Canada's got to raise interest rates to fight this inflation. And their target is 2%, yet inflation's like running an average of 5.1%. But in reality, I actually think it's a lot higher. So I want to get, what do you think about the direction from Bank of Canada? What do you think that will happen? Is there a history that could help us indicate what Bank of Canada will do?
Okay, so excuse me for 1 minute. I'm gonna go consult my oracle, and I'm gonna come right back in to comment on this question. Okay, I'll see you.
Yeah.
So
You're like,
that's the thing with rates. That's the thing with rates, Tracy. The problem right now is that there are a lot of things that are influencing the rate. So inflation is just one of them. Commodity prices, consumer debt. There are inflationary and deflationary forces enforcing the rate environment, and no one really knows how exactly it's going to look like. But what we know is that we have hit rock bottom with rates, so it's upward from this point. Number one. Number two, we know that inflation is always a concern for the Bank of Canada, and they've commented on the fact that it's higher, it's coming in higher than they anticipated, and they will want to, control that. So the rates will go up. Now, at what pace and at what pace is the question. So what we know is that the rates are likely to increase by another 0.75 to 1% this year. The Bank of Canada increased their overnight rate by 0.25 on March the 2nd. So this year, the expectation is that it will go up further by another 0.75 to 1%. And in early 2024, we're looking at another 0.25. So they will go up and likely to go up, by this much. At what pace, we don't know yet. Generally, the bank increases the rates by 0.25 increments. Now,
okay.
With this news in mind, or with this expectation in mind, should we panic? Should we go all and rush into fixed rate mortgages? My suggestion is not to. And what I am sharing with the investment community right now are a couple of things. One, historically, when you wanted to lock into a fixed rate, the gap between fixed and variable was small. Right now, we're talking about 150 points or a little more to actually lock. So if you're on a 2% variable and you want to go with a 5 years fixed, you're going to pay 3.5% to go fixed. So there is quite a bit of a runway for variable rate to rise. And that gives me comfort that, there is a runway to rise. If you don't panic and you can sleep at night and you can stomach the announcements, there is quite a bit of a runway for variable. And it doesn't make sense, in my view, right now to lock into fixed because you're going to pay an extra 150 points immediately. Okay. But there are other benefits to staying variable, which I can comment on as well if you want.
So you were talking about variable and fixed rate. So I have the situation where I bought my rental unit and I was like, oh, I'm gonna hold it for 30 years. And then, it's an older unit, has a lot of maintenance expenses. It's really, really old. And unfortunately, I converted to a fixed mortgage. And because I thought I'm going to keep it forever. And when the mortgage runs out, I'm going to build a multiplex. Now, of course, situations change. The house is old. And I kind of thinking, I might consider selling it. So good news is that I have a very small mortgage. I do have to pay a penalty. I still have to penalty, but not that big of a deal because my mortgage is so tiny. So I'm saved that way. But what do you advise investors if they're looking for a rental with a 5 to 10 year hold? And then what if they need to do big renovations, access their equity in the next 5 years? Considering that interest rates are going to kind of rise again, and it seems like it needs a big rise to catch up to the fixed rate. So what do you advise for investors, that situation?
So I'm going to answer this question in chunks. The first comment is around how do you actually hedge against a rate rise if you are in a long-term hold? Okay. I would highly recommend that everyone stress tests their portfolio. So you take the property you're buying, or you take existing properties, and you increase the current variable rate by 1 to 1.5%, and see how that impacts your cash flow. If the property is going to absorb that payment increase, and generally on $100,000 mortgage, at 25 points increase translates into roughly $15 increase. So if the property is able to absorb the increase, stay variable. Don't panic, okay? Because variable gives you, as an investor, a lot of flexibility if you're looking to grow your wealth, because you can recycle equity, you can sell, and do a lot of things with minimal penalty. So stress test. If the property is not going to carry, then you have to ask yourself the question: am I really can I do something to increase the rental income going into this property? Or if it's an existing property, can I do something to increase the rental income? But some of the tricks that we use outside of rental income is you can stretch amortization, take a 30 years instead of 25 years. Immediately, you reduce your payment. That's one way. Another way is, instead of taking it all as a mortgage and pay principal and interest, you may take part mortgage, part line of credit. So you pay it's an interest only payment on the line, but it reduces how much cash out you're putting, and it helps you cash flow on the property. So if you're in a long-term hold going into a deal, or you currently have a property at hand, stress test with a higher interest rate, and then go about it the way I suggested. The other thing that we're seeing investors do, obviously, also in this market that we're in, is they're using a little bit more aggressive strategies going into deals, like renovate to increase the rent, add a unit to increase the rent, do something to push the rent up to give you a little bit more of a hedge on the revenue side versus just interest rates. So these would be my thoughts around long-term hold properties. I think the second question you asked is about taking out equity to renovate, right? So I am not a big fan of taking out equity in the form of bigger mortgages and adding a big payment now that eats into your cash flow. And when you take money as a mortgage, a bigger mortgage, you have this money at closing from the lawyer. It's sitting in a bank account costing you principal and interest, and you may not use it immediately, but it's collecting interest right there. And it's costing you money every month right there. So on renovations, or generally on any equity takeout, I'm a big fan of lines of credits. Take it as a line of credit. You have money sitting there. It's not costing you anything per month, no pressure. When you use it, you pay interest. Yes, the interest is a little bit higher, but your monthly payment is lower. And with some products, you can convert it back to a mortgage if you want to start paying that debt down. So that's my recommendation on equity takeouts.
Right. Okay. So what I'm hearing is that you encourage the variable rate, is what you're saying. And it gives you more flexibility if you also choose to take it as a HELOC versus actually refinancing and getting it as a cash out refinance. You encourage doing home equity line of credit, because then you're also at a discretion. You have more flexibility, is what you're saying. So I hear you. That's good. I was going to say, though, so you're really discouraging going the fixed because, first, the spread is too large. And it really can, like my situation, I realized putting yourself in a fixed rate and then all of a sudden changing your situation where you're like, it's not a long-term hold anymore, I'm actually considering selling it, then you have this big penalty you have to pay out. And if you have a big mortgage and you have to pay this fixed rate penalty, it can amount to many, many, many thousands of dollars. So I was just talking to my realtor the other day, and I noticed how little amount of properties are available in the market, especially in Ottawa. I'm sure it might be the same in Toronto. So I'm just seeing, like, because you're in the back end, you're seeing these deals come in. What are your thoughts on how this is impacting the Canadian real estate market? You're seeing it in Toronto and the Ontario area. How is interest rates affecting the deals that you're seeing right now?
So of course there is a direct impact between interest rates and affordability, right? You go buy a house for 800,000, you calculate the mortgage payment at today's interest rates, and it's affordable in today's dollars. But once the rate rises, of course, this means more coming out of your pocket. Direct impact to affordability. So what I and again, I'm gonna consult my oracle on this. What here's the thing. I don't think the market is one big market when it comes to properties and how interest rate increases hit the different areas in the market. What I see here on my end is a property market that is, I call, mass market type of property, which is, up to, let's say, 800,000, 900,000. And that's where, investors play. They want to get there. They will still cash flow. That's where first time home buyers play. They can still get into the market. And then you have the higher end properties that are above the $1 million. When the Bank of Canada raised interest rates leading to the stress test in 2018, what happened is it did actually slow the market. However, it hit the property types differently. The higher end properties have actually seen a decline in value because the demand slowed down a little bit, where the mass market properties continued to fuel because the demand didn't go away. So will this slow down the market? I would say it will probably inject some slowdown for the higher end properties at some point in time, but I don't see how it will impact the mass market properties because there's so much demand between home buyers and investors, and these are the properties that will continue to be more affordable.
So true. Because I was going to say, when I'm reflecting on my 14-year journey investing in real estate, is exactly what you hit. Like, yeah, interest rates were like, what, 5%? I remember 5.6% in 2008. And yet, but the houses I was looking at that time, they just kept doing its thing. The every year it just got more and more expensive. But the higher end units were the ones who are slowing down, as you were saying. So it's interesting that you note that it's because it's a supply and demand. People need housing as an essential need. And so the starter homes, the two, 3 bedroom, 2 bathroom, or the condos, people always need them. They need a place to live. Is that kind of what you're saying? Is that when you're talking mass market, you're talking about people need housing, and housing is going to be always in demand. Do you feel like, have you seen a change in the markets in that there's less properties available as well? Like, I'm just wondering, from the dynamics of Ontario, I've noticed it in Ottawa.
We're still seeing multiple offers, competitive offers above asking on properties. We're still seeing a shortage of supply and many offers going in, which obviously reflect demand. So I haven't yet seen any slowdown here in Ontario.
Say Bank of Canada raises their interest rates, what you said, by about 1.5% by next year. What do you think? That are they going to start putting more rules in place to kind of cool it down? You've been through many different changes in the different types of stress tests that Bank of Canada does. So what else do they have left?
Well, there's been talk. Again, not at the Bank of Canada, but there's been talk, and I don't know if it's actually going to happen or not. But again, the government is concerned about the heating markets, and there are always ideas about intervening to slow it down. And was talk about requiring higher down payments or putting some guidelines around, using leverage to invest. Is it going to materialize? I don't know, but I don't see how these policies would actually slow down the demand, because the demand is there and there isn't enough properties in some, there aren't enough properties in some market, and again, supply and demand. So in the mass market segment, I don't see any crash or significant slowdown, but in higher end properties, there may be some impact.
Right, right. Well, this has been super interesting. Thank you so much for answering all these questions. I mean, we consulted your oracle.
Answer, not me.
It's pretty good. So if people want to get a hold of your team, consult these different types of strategies, talk about the fixed versus variable and the end game with their rental properties, where do they go?
Simply email us at info@streetwisemortgages.com. Many clients are reaching out to us right now for guidance around how they should hedge and if they need to restructure anything to create room in their budget to absorb any additional payments or rate increases. So we're happy to help, and just email us at info@streetwisemortgages.com.
Oh, thank you.
You're
Thanks,
welcome.
Dahlia. Hello, everyone. I hope you enjoyed that interview. If you want to contact her team, check out the links below. Her team has built this financing roadmap, which is actually one of the critical things that I used from her team to help me buy more and more rental properties beyond what I actually imagined. I thought like I was only able to buy like a few, but in reality, you could buy so much more. And she's built this financing roadmap to help Canadian real estate investors to scale their rental property portfolio to way bigger than they could have originally imagined. So if you want to talk to her, be sure to click the link below. Anyways, if you want to learn more about how to finance more rental properties, check out this playlist here. Or you're an aspiring real estate investor, or you're in the thick of your real estate investing journey, then you want to check out this video here.